A splendid evening it is to viewers. Welcome to Equity News on Equity Access, your cross-section of the stock markets and of developments in the Zimbabwean economy. Thank you for joining us as we broadcast live from our Hampton studios in Harare. I'm Ibn Mabunda. Let's get started. Government ditches the multi-currency system through an official tweet released by the Ministry of Information and Publicity through their official Twitter account. The multi-currency system was introduced in 2009 following hyperinflation that hit the world records. This comes after statements issued by the president to the effect of the adoption of a local currency a couple of weeks back. For background, let's just have a look.
Saka hazvigoni kuti nyika yebudirire kuenda mberi ine mari yedzimwe nyika isina mari yayo. Mari yedzimwe nyika inogadzirwa nenyika idzodzo. Imi munongoiwana nokunge matengesa zvinhu zvenyu kunze kwenyika. Mobhadharwa nemari dzokunze kwenyika. Kana vane hama neshamwari dziri mudiaspora vanotumira mari idzodzo and so on and so on. My investments paanovuya achibva kunze vanovuya vane mari kunze ikoko. Asi senyika tinosungirwa kuva nemari yedu. Saka rwendo iroro tarutanga. Saka
Now, this afternoon, the Minister of Finance, Professor Mthuli Ncube, shedded light on the development. Let's have a look.
The end of the multi-currency regime in Zimbabwe and the adoption of a mono-currency regime in favor of a domestic currency. What was happening in the market is that the market was self-US dollarizing. It was uncontrollable. And we felt that we needed to bring the situation under control. A few days ago, I had a meeting with the Association of Teachers in this country as a union, along with His Excellency as well as other ministers. And they made it very clear to us that the multi-currency regime has become a US dollar regime. They don't earn US dollars. They can't afford to buy things in the shops. They can't pay for medicines and healthcare services where the hospitals and clinics are demanding US dollars. Quite clearly, it became an untenable situation. It became necessary for government to move a lot faster and introduce a mono-currency regime with a domestic currency. The domestic currency obviously comprises our RTGS dollar as before, as well as the bond note and bond coins as before. So nothing has changed really in terms of what we're calling domestic currency on this occasion. All that has changed is that the only legal tender domestically at the moment is now the domestic currency and not foreign currency of the US dollar. What does this mean? It means that anyone who wants to buy goods from a shop, they pay for services within the borders of Zimbabwe, ought to go to a bank, or to exchange or some other institution to change their foreign currency into domestic currency and spend that whichever way they wish to spend. That's what normal countries do. That's what all countries do. If you go to South Africa, you cannot buy in US dollars in the shops. You go to Zambia, you cannot buy in US dollars in the shops. You go to Mozambique, say.
Now, just to shed more light and to give perspective as to where Zimbabwe is coming from, 2008, record-breaking inflation. 2009, we see the dollarization of the economy. Now, between 2010 and 2012, we see the economy growing and being boosted by that initiative that was actually taken by government. Moving on to 2014, government introducing borrowing in the local market. Between 2016 and 2017, we see the introduction of the bond coins as well as notes in a bid to incentivize exports. 2018, we see the separation of FCA accounts from RTGS balances. Then in 2019 February, we see the introduction of the interbank market system as well as the RTGS dollar. Then just a couple of weeks back, we saw the president coming in to hint on the introduction of a new currency. In the same vein, the Reserve Bank of Zimbabwe has revised interest rates upward from 15% to 50% in line with inflation trends. Now, this is according to a press statement issued by the Reserve Bank through their official Twitter account this evening. This, of course, would be the statement that has been released by the central bank. Key to the statement is the fact that admin caps on operations of bureaus have been removed. Also from the statement is the fact that trading of dual listed shares previously used as a route to liquidate local currency denominated securities has been made tighter to close leakages, and RBZ now requires a 90-day vesting period before one can transfer shares between markets. The Minister of Finance yesterday hinted that he is abandoning austerity policy just 6 months after implementation. He presents that Zim has already achieved macroeconomic stabilization. Meanwhile, the Parliamentary Committee on Transport today convened with the National Road Agency ZENARA being quizzed on the operations of the entity. Engineer Maua, who is the acting ZENARA CEO, says their budget has been compromised by the introduction of the interbank market system. Harare's sole 5-star hotel Miko's Hotel is set to change hands after the Competition and Tariffs Commission approved its sale to Al Buwadi Investment, a Dubai-based entity. The deal is still subject to approval by the shareholders of the entity at an extraordinary general meeting soon to be held in the capital. Other regulatory approvals from the ZSE, SECZIM as well as RBZ are still pending. The hotel has been owned by Miko's Holdings for over 100 years now. This concludes our evening news bulletin. Up next is a look at the news. Please stay tuned. Welcome back, viewers. It's now time for news review, and with me on set is Chief Analyst Respect Wenzi. Respect, good evening and welcome to the show.
Thank you, Eben. It's always my pleasure.
Splendid. Now let's get the ball rolling. Miko's Hotel getting that approval there from the competitions board to dispose of their Mikos Hotel. I mean, Mikos Limited getting the approval for the disposal of Mikos Hotel. Would you want to shed more light where that is concerned?
Yeah, so the group has been undergoing restructuring for quite some years now. We saw that a few years ago they went into partnership with a South African company, one of the largest retailers, which is Pick n Pay. So they came up with what's called TM Pick n Pay. And so TM Pick n Pay is now running about 20 shops out of the 50 that were owned by TM, under the TM supermarkets within the retail cluster of the Mikos group. And that restructuring, of course, it injected a bit of some liquidity into the group. It rejuvenated the retail arm of the group. And of course, we've seen the benefits over the past few years. It has been one of the leaders in terms of driving both revenue and profitability. And so when you're looking at the recent development where the hotel side of the business has also been struggling, besides struggling, the company has been it has had a huge debt mounting on its books. So obviously it weighed on its operations, and the hotel cluster has been underperforming within the group. But it's quite symbolic because it retained the name of the founders. Of course, now it's in the third generation under the Mokson family. But the Mikos brand is a strong brand in Zimbabwe. It's known predominantly on the retail side. So I mean, the recent developments, of course, they have an impact on how investors look at the company. But generally, it's meant to enhance the financial position of the group through freeing up of financial resources.
I realize. Now, to get into the topical, I mean, interesting developments there. First of all, we get this statement here from the Minister of Information and Publicity, making us understand that government is dealing away with the multi-currency system, which was introduced in 2009. Of course, this had run for a good 10 years. What is the implication of such a move by government?
It has quite some numerous implications. But basically what it means is that we'll no longer be able to trade in any other currency outside of the Zim dollar within Zimbabwe. So it means if you are a worker, you are supposed to get your salary in local money. If you're transacting, you're supposed to transact in local money. If you're dealing deals with any counterpart, it has to be recorded or registered in local currency. It also affects remittances. It also affects any other inflows that come into Zimbabwe. By the time you want to transact, it means you have to change them from the respective currency from the country against which the money is coming from to the local currency. So by implication, it formalizes, or it brings an end to what was called a multi-currency regime, which is a regime that we adopted in 2009 as a way of trying to stabilize the macroeconomy, which was characterized with low production, high inflation pressure, and of course the economy was almost going into a comatose situation. So these are some of the key things that were solved by the dollarization. But after 10 years, we have endured a lot of pressures, predominantly on the production side. Remained a low producer. Why? Because it is believed that USD denominated goods, they are not competitive in regional markets. Therefore, it affected trade. And as of recent, we have seen the disintegration on the monetary side, where we have a runaway inflation driven by an RTGS dollar, which was introduced into the economy through treasury bills and heavy government reliance on private sector debts. So I think it's a whole lot of complicated process, but at a point where we are today, there is a real uncertainty that's right over Zimbabwe right now. Things may go either side, but government has taken its bet. Its bet is that the local currency should stabilize at a weaker rate to the USD.
But would this not perhaps get us into a process where we will eventually have to print more money, since this is now what we're actually running with, and perhaps lead into further money supply, inflation, the cycle goes on and on?
I think government might have learnt its lessons in yesteryear. Why? Because the immediate move was, after it has after issuing this statement, they immediately went on to recall about 1.2 billion worth of foreign obligations to say, guys, we have to release this 1.2 and sterilize or reduce the quantum of local money that's in the system, so as to it's a dilution effect. In other words, if you have got two substances within one container, if you reduce the quantity of one, obviously the other gains a certain margin against the one that you are weakening its respective quantity. So what it does is to sterilize the amount of local money that's in the system, or neutralize against USD. So under that scenario, using market forces, you would, because they don't have the money, and this is real US dollars that they've promised to pay. So it's actually another debt which they will have to government, is because there's a high quantum of RTGS dollar that is trying to fetch, or that is trying to move out, and that which is trying to move out is predominantly dividends, payments of payments to creditors, and also payments to suppliers as well. So these are some of the amounts that that were hanging on the economy. And so if you remove that quantum, obviously the immediate expectation is that there might be a short run impact of a reduced rate. And they've now also removed the caps on the interbank.
Of course, now you're making reference to this development of a statement issued by the Reserve Bank of Zimbabwe, making reference to how there's actually been an increase in terms of the interest rates, removal of those caps, as well as a 90-day period where the disposal of dual listed securities.
Yeah, so I think we'd rather look at them one by one.
Sure,
yes.
sure.
So starting from where we are in terms of number one, which is direct bank transfers, what's key to highlight there is that banks, the direct bank transfers to the RBZ, that is RTGSW, that they are holding as counterpart funds for the foreign currency, historical or legacy debt. What this simply is referring to is it's the amounts that were owed by local entities to foreigners.
Right.
So the quantum is believed to be in the range of about 1.3 billion.
Okay.
So what RBZ is saying is that immediately all that money, it's registered in local books as RTGS dollars. Okay. But to a foreigner, it has to go out as real USD. So when we separated in February, when we changed the functional currency, RBZ said we're going to assume all the debt that is due to outsiders. Okay. We will pay the difference. Okay. But what banks are holding is the local component. They don't have forex to monetize the local component to make it to make equivalent of what they can send there. Why? Because there's now an exchange rate. So they had to maintain a certain balance, and that balance is assumed to be 1.3 billion RTGS dollars. So RBZ is saying, bring that money to us. Okay. In RTGS terms, then we will find US dollars from our own coffers, and we will pay the difference. But so what they will lose is what they've gotten from the banks minus possibly the interbank differential. But essentially, they have reduced the amount of RTGS dollars that's in the market. Okay. That's the process which I'm calling which is called sterilization. So that measure might help to stabilize the interbank rate by lowering the amount of RTGS in the system. So it's one of the confidence building measures. The measure is expected to mop up around 1.2 billion from the market by end of this week. So this is obviously trying to hype. If you obviously make a policy stance, you would want people to believe that this is what it's gonna be like. Okay. And I believe that it's not as difficult for government to do, but the issue is how sustainable is the measure, and are they able to last the mile while containing that rate, while containing that debt, because they've essentially created a certain debt, and that debt obligations, they have to figure out a way of negotiating with the with the guys whose monies are already due. But obviously, they want to take out something from the market.
Now,
Getting to number two, which is quite critical. This is about interest rates. So interest rates have become suboptimal, an average of about 12 to 15, and now it's being changed to 50. But this is mainly a measure of trying to push the rate towards the present inflation in inflation rates. But I think what's key to note here, the impact of interest rates on money supply is such that when you increase your interest rates, you reduce the propensity for a borrower to borrow. So a borrower no longer has the same appetite of borrowing than they had at a lower interest rate.
Okay.
So essentially, what that does is it limits money supply growth, because credit grows against borrowings. So if you borrow, it means you are increasing the money supply in the economy. So by increasing the interest rate, you are essentially limiting the amount or the number of people who are going to borrow. But it has got its own downside. Why? Because banks' NPLs are a threat. At 50%, it essentially means that possibly half of the population are no longer able to borrow. Why? Because they are no longer able to repay, because they don't have the capacity to do so. Why? We are looking at the present income levels in the economy. They cannot, you cannot sustainably service your debt levels. But this measure is meant to cushion the growth in money supply,
okay,
by increasing the interest rates. So it's one policy measure which policymakers can utilize in instances where they can where they can run or they can tweak money supply, or they're in control of their own monetary policy.
Now on to the removal of administrative limits on the operation of bureaus. How important is that?
I think this is not really a big deal. But I think Beirut changes were allowed something like 10K to 20K on a daily basis. They were not allowed to go beyond that. I think it was just a measure of trying to keep their activities in check. But I think what's more important is the point that follows on that,
okay,
which is the cap on margins, which cap on margins for banks on the interbank trade. This is one of the key. This is been one of the key contentions or weaknesses of the interbank market.
Okay.
Why? Because we were realizing smaller gains or smaller increases in the interbank rate on a day-on-day basis. But in as much as there were smaller gains, we also realized that there was no liquidity on the same market. So government had put a cap to say on a daily basis, rates can only rise by this much. If it gets to a certain point, there was a circuit breaker, immediately you have to stop trades.
Okay.
So what happens to everyone else who has got demand on the market, who is trying to buy dollars on the market? It means you're actually pushed out. So the rates are low, there's a circuit breaker, and so you cannot maneuver. So sellers were shying away, or they were going outside the market and saying, guys, if you want money, come to us, we have an off the market deal. And that's why you were seeing trades that are, parallel market trades that are quite, higher than the interbank rate. So removing caps essentially means it's now game on between the two players, which is the parallel market and the formal market. So as of tomorrow, we will see both players are now at par, and it might, of course, it's likely to bring in some real interesting dynamics in terms of the prices. I think my own forecast is that it might create a sharp shock in the very short term, especially this week, and maybe a stability as we go. But I think what this point number one is trying to emphasize is that, guys, don't worry. By week end, we'll clear everything that is due to outsiders. So it's game on between players who are within the economy. So that's about point D, which is one of the most critical factors of why the interbank has not been working to date.
Okay. And then the last one, increase of foreign currency to the interbank market by ensuring that at least 50% of the proportion of foreign currency is sold to the interbank market. How
on this
important
one,
is that?
It's quite significant if government plays ball, but there's no measure of how you can enforce that RBZ can submit what it earns onto the interbank. There's no mechanism of ensuring that. I think the most sure way of doing it was to let market players decide what or to increase retention levels for exporters. What this means is that if you are giving me 50%, give me 75% and I'll create an excess liquidity of 25 and I'll sit that to the market as an independent player as and when I want to do so. But as government, there's no obligation and there's no person who can regulate you to do what you've promised to do what you've promised to deliver. So I think this is just a measure of trying to show the market that, guys, we want to play our part. We want to actually increase liquidity in the market. So from what we are getting, 50% we'll submit it to, but there's no one who can measure to say, have you really seen through what you have promised to do? But I think point number 2 as well, which is about letters of credit. The danger of letters of credit is that it guarantees the buyer a certain rate. So suppose we want to purchase fuel today, and we say the rate is at 6. So it means the government is promising to pay the end person today. So I have to seed my RTGS at a price of 6.
Okay.
But government may possibly recover money when the rate is now at 10. So if we use a simple equation to say they probably have to participate on the market, or they probably have to incur a certain cost from an Afrexim Bank loan, it simply means it's coming at a cost. In other words, they might be still subsidizing the local market. That's what it means. If you fix a rate, or if you fix a letter of credit today, and yet you don't have the money today, you get the money tomorrow, which now comes at an interest or at a higher rate on the interbank, it means you are losing out in that differential. So it might mean government will still be subsidizing the economy. But on a more fairer note, it also means that government essentially is relieving pressure from the interbank. A producer of cooking oil no longer has to go onto the interbank. Government is allocating them special credit. In other words, you no longer have to be part of the demand that is pushing price on the interbank. We will exempt you, we'll deal with you personally, just like we are dealing with 1.2 billion. We'll give you letters of credit, we'll let you buy, but you are giving us possibly at a certain market rate. So those are the dynamics around those key points.
Well, it'd be interesting to see how things play out. Thank you, Respect, for the perspectives. Thank you, viewers, for staying with us. Up next is a look at the stock markets through Market Daily. Please stay tuned.
Welcome back, viewers. Welcome to Markets Daily on Equity Access. My name is Anisu Chimbumu, and joining me today is Respect Gwenzi, our Chief Analyst. Good evening, Respect. How are you doing today?
I'm doing just good, and you?
Very good. Turbulent day today with the government coming in with that
Market
huge
changes.
Yes, exactly. And the market has reacted somewhat a little bit less than I expected. I suppose investors are still trying to hold on to their investments and try and find out where the market is really going. But as usual, with the top 10 index being the huge influence on the market as of late, it has caused for almost a similar magnitudes of movements on the stock exchange today, with the all share index and then the industrial index both going up 4.05%, for the industrial index to settle at 773.06 points, while the all share index is at 231.74 points. Top 10 index 228.5 after adding 4.95%. Major movements from Econet with 11.27% movement there. Cassava also up 7.4%, and Natfoods is finally out of the red on a year-to-date basis.
I think this is quite a significant trading session. Of course, the gains might not be as firm as you possibly projected, but still 4% in a single session is still quite on the high side. My own thinking is, of course, when you look at the top 10 counters, it's only one counter which traded in the negative. And of course, Old Mutual was one of the casualties of the new rules. Why? Because it now requires you now required to hold the securities for at least 90 days before you can transact it in another jurisdiction, and that's quite like 3 months. So it discourages trade in that security, but it's also government's way of trying to protect leakages within the system in terms of movement of dollars, or maybe trying to discourage hedge seeking moves by investors, because Old Mutual is used as a proxy to the exchange rate, and once people buy more into that security, what it simply does is to push up the price. And when you're looking at the price differential from the JSE one, the implied rate now comes up very high. So they're trying to minimize and manage demand of Old Mutual shares by curtailing or managing the holding period, or the period over which you should hold the security before disposal. So it used to be quite easy, but it's now more tighter. And against that, of course, it came off, I mean, before those and the announcement. Much of the board, it's quite green. And this coming from the top 10 counters, it shows you the magnitude and the depth of demand on the market, and the sentiment really to say everything else is quite on the green side. And that points to hedge seeking behavior right across the market.
Okay, I think if we just have a look at our week-to-date performances, our all-share index is up 5.8%, still a show of how mid-tier, low-tier counters have still had the huge drive on that market. I mean, we also have a market breadth of about 19 today, with 20 counters having gone up, one coming off, which was Old Mutual. Old Mutual, I would think, is expected to continue on a downslide for the next couple of sessions, mainly because of this whole 90-day vesting.
Yes, it might come off a bit, but it depends with the sentiment. It depends with projections, because if you're an investor and you're really anticipating that the outlook for Zimbabwe or the outlook for the currency might be negative, then you're better off holding on to that share and ride the 3 months before you could sell. But at least, I mean, it gives you an opportunity to protect your value and lock your value at a certain price.
All right, Dawn Properties was up 19.94% as at the close of session today, selling at 4.03 cents. Lafarge up 17.7% to settle at 138. Econet Cassava both up. We've already touched on those. But Meikles had a very significant announcement today. CTC has pretty much approved for the sale of the Meikles Hotel from the Meikles Limited Group. Now, what do you think could be the implication for Meikles? I mean, I do think that the Meikles Hotel side of business was not very much
Yes,
was
I
not
think
very much.
you're quite right in
good.
terms of your assessment. If you're looking at the structures of the group, it's more like there is a retail segment, there is an agri segment, and there's a hotel segment, and the mining segment was discontinued after the center deal did not quite work on well. But if you're looking at the retail, it's quite the cash cow. It's also one of those top performing within the portfolio. But this is essentially because Miko's managed to invest, or in fact they managed to solicit investment via Pick and Pay quite a few years ago. And as I've discussed in the previous engagement with our anchor, it's quite apparent to note that they have learned a lesson that if you get, despite you having scale, because they had reach in Zim, but they no longer had capital to capitalize the operation into a modern day retail. And this they achieved through partnering Pick and Pay of South Africa. And Pick and Pay managed to capitalize some of its operations, and they had a 51-49 deal in TM Pick and Pay. And that entity has been giving the biggest player in the market, which is OK, some sleepless nights. They've been gaining ground in the top end of the market, and they've been rolling out 20 brands. Of course, OK has got over 50 branches, but still they have given a new lease of life to the TM supermarkets. But now when you then try to look at the hotel operations, their portfolio is such that they controlled 2 hotels exclusively. One that they jointly own in Vic Falls, as well as the Harare one. It's quite a 5-star one. It holds the name of the group or of the family that started the company, so it's quite symbolic. And also the group's name is also derived from that same name, which is shared by the hotel. So I mean, it's really a symbolic name, and it has got some serious brand equity in Zimbabwe. If you see at the depth of TM stores, it shows you that they are a trusted brand in Zim. But this is something that I personally think they had to do, because it wasn't their core competencies. I'm sure their agri side has been doing well. They are expecting to expand, especially on the macadamia side. Their tea operations has been doing good, but they are the biggest player in the macadamia space, and they want to double up their capacity within that operation. And they have not had so much good cash flow positions in terms of their overall balance sheet position. They had obviously some debts to worry about. And I believe that by disposing of this hotel, they essentially are freeing up resources. They are trying to liquidate the business. They're trying to focus into some of the core things that they are known for, which is predominantly the retail side and the agri side. They have quite a healthy agri operation, which is mainly in the Chipinge area of the Manicaland region, and they've been doing quite good on the export market.
Okay, so would it mean that competition for Dawn Property hotels would pretty much come in very harshly? I mean, I do understand that the deal is with a UAE investor who is pretty much also invested in some of Four Seasons hotels, which is pretty much high quality.
Would expect some market shaking obviously moves. The competitor or the guys who have bought into Miko's, they have quite an expansive portfolio. They're conversant with the African market. They also deep-pocketed as well. So that obviously shows you that they really mean some good game to the market. So they're bringing in something, and it means guys who are in this market have to tighten up. But Miko's has always been in its own class. Presently, it sits on top in terms of all the city hotels in Zimbabwe. So I think it will further broaden, it will further widen its gap to the rest of the market. But then also, quite essentially, I think this is an entry point to the player. I believe once the player is in place, they might even try to expand in resorts, especially the Vic Falls area and so forth. These are some of the opportunities that they might be looking at. So I think it means something.
Okay. Just quickly onto the forex market now. As a close of day, RBZ did give out an announcement, issue a statement that had much to do with how the interbank market is going to be performed, is going to be trading henceforth. I'm sure if it is starting tomorrow, where they have fully taken out all of the caps on that market. One of the reasons could be for some sterilization of the currency. What's your take around that sentiment there? Would the local currency then strengthen a little later into the month, or into the next month, or
it depends.
would that rate continue to weaken?
From a fundamental perspective, I think once you take out a sum close to 1.3 billion, it's quite huge. It has a huge effect on reducing the RTGS balances in the market. But I think outside of the aspect of fundamentals, sentiment itself is also a key driver. But what government is simply trying to do here is to say, guys, let's just clear our books. Let's just clear the financial system, the financial services system. Let's take out all the RTGS, which is dirty money, and let's leave some residual balances in there, and let's start to build from there. But I wouldn't speak on their behalf. I mean, they've not really had a good track record in terms of managing these things. But this is the game plan. It's trying to mop up the excess liquidity, trying to reduce the percentage of RTGS to USD, so as to try to make the currency firmer. But this is a real gamble. I don't believe that the fundamentals in the economy are really in good shape. So if fundamentals are not in good shape, it means you end up borrowing. It means inflation cannot be tamed. It means corruption is not rooted out. I mean, there are some real deep structural issues that are still, so you cannot tinker around with just money supply, monetary policy instruments so as to solve a fiscal crisis. I mean, you need both legs, like what Julie has always said, but I don't think that the monetary can solve the fiscal. It might be a combination of both trying to help it, but at this point I feel that this is a rushed move. It might go either way. It may work if government is sincere about reducing the quantum of RTGS money, but it might also not work if these underlying factors that drive an economy are left unattended to, because players will simply want to pay a premium just for them to hedge themselves against the downside of a weaker structural economy.
All right, thank you, Respect. Will it work? Will you work? Is it simple? From the Equity Access team and I, don't forget to like, follow, subscribe our YouTube, Twitter, Facebook, and follow and actually visit our website, www.equityaccess.net. Our handles are @equityaccess. And we do thank the production team, Brighton and Tanaka Ranganawa today. Thank you and good evening.